our featured guest today is Peter Schiff. He's the CEO of Euro Pacific Capital. He is here today on Open Exchange, and we're going to talk about why he's bearish on U.S. stocks and favors instead companies outside the U.S., including utilities, commercial real estate, and energy. Now, let's just get a quick comment on these markets from our featured guest, who's right here in our studio. Peter, thank you very much for coming in our offices today. The first thing we got this morning was these details about the ISM and how manufacturing activity is picking up. Seems, at least on the face of it from the headline numbers, that indeed manufacturing is picking up. What do you think of that?
Well, I think the numbers are pretty volatile. I'm not really sure what it is we're manufacturing in this country, though. That's one of our problems. But I think the most interesting part of the announcement was the prices paid numbers that you alluded to. In fact, if you look at the two most recent months, you see that this is the biggest back-to-back monthly increase in prices in over 50 years. So while the government and many on Wall Street are trying to tell the public that there's no inflation, I think investors need to tune out that propaganda and take a look at what's really happening, because I think today's numbers are reality. There's
basically, I think the conclusion, or at least some of the reasons for this pickup is, of course, the oil prices. And what people are saying is that you have to separate the oil prices from what's going on in the rest of...
I think that's just a rationalization. I mean, oil is rising because of inflation. Just like it has in previous periods. You don't want to make the mistake of not counting it and thinking, well, if prices are rising because of oil, they don't count. Oil counts. You can't not look at it. But of course, when you have a vested interest, certainly Washington, the government, has an interest in fooling the public as to the severity of inflation. I think Wall Street in general has a similar interest, and so they try to present a confusing picture of inflation. They hope to convince the public that inflation isn't a problem, when in reality it's a serious problem.
Now, not everyone is convinced that the rise in energy prices is about to turn into a broader problem. San Francisco Fed President Janet Yellen told a London conference last week that while core inflation may rise temporarily, a more persistent increase seems unlikely. And Mr. Schiff, I understand your concerns about inflation here. I want to get your sense if you think there's any possibility the Fed would actually start getting more aggressive with its interest rate increases. Perhaps we could see some half-point increases in the future. What's your thought on that?
Well, at some point, certainly they will. I mean, they have no choice. And I don't believe that it's rising energy prices that are causing inflation. It's inflation that's causing energy prices to rise. And inflation is already very rampant, I think, throughout the U.S. economy. And, you know, the government is trying to point to this erroneous core CPI as evidence that inflation isn't a problem. And I think the core CPI doesn't really reflect what's going on. I think there's a lot of numbers in there that are being manipulated and, you know, with hedonic adjustments. And a lot of the core CPI, which is comprised of owner-equivalent rents and used car prices and things of this nature, which are actually paradoxically being artificially suppressed by the higher levels of inflation.
Does that mean that you would expect the Fed to be more aggressive, to go well over 4, possibly 4.25%?
Well, at some point they're going to have to, or the market's going to force their hand. Right now, I think what the Fed is doing is they're trying to act tough, but they're trying to drag their feet because they realize how vulnerable the U.S. economy really is to the higher interest rates that would be necessary to really put a lid on the inflationary pressure. So I think what Greenspan wants to do is try to pretend that the Fed is being vigilant so that interest rates in the long term will stay lower, but at the same time, you know, they're just allowing inflation to accelerate because there's really nothing they can do at this point to combat it.
Is that part of the reason why you are very negative in terms of your views for U.S. equities?
Well, certainly. I think what the U.S. has in its future is a very severe recession. Maybe it'll start next year.
Why? Why is very severe recession?
Well, it's going to be brought on by a big increase in interest rates and consumer prices. See, right now, the reason that Americans enjoy low interest rates is because foreigners are foolishly lending us their savings, and we're using those savings to buy their goods, which they manufacture. So we're running this huge trade deficit, and we're financing it with borrowed money. And I think as foreigners wake up to the reality of the fact that we can't repay them in currency of the same purchasing power that they lent, I think you're going to see a big reluctance on the part of foreigners, particularly central banks, to continue financing this. And so you're going to have a spike up in interest rates. Consumer prices are going to rise. That's going to prick the real estate bubble, the stock market bubble. And our whole economy is based on access to cheap foreign credit.
Well, there's been a lot of discussion about the foreign access and the foreign interest in U.S. assets. whether it be in congressional hearings, whether it be with Chairman Alan Greenspan. And we keep coming back and hearing that there is no sign of waning in terms of foreign interest in U.S. assets. In fact, it's arguably one of the safest places for them to put their money, and it's certainly one of the better returns that they're getting on their money.
Well, I think that'd be a losing argument if somebody tried to advance it. I mean, there's certainly evidence.
Alan Greenspan is advancing that one and has advanced it for quite some time.
Well, Alan Greenspan says a lot of things that aren't true. He has a vested interest and he has another agenda. But if you look at the reality, if somebody says there's no signs, take a look at all this foreign central bank buying. The reason that foreign central banks are buying is because there's no private demand. Private individual investors around the world are already getting wise to this. They don't want U.S. dollars. That's why their governments, through taxation or through almost at gunpoint, are investing taxpayers' money in U.S. Treasuries. So people aren't voluntarily doing this. So the fact that so many central banks are buying, that's a great warning sign that the game is almost over.
But we have seen no deterioration in the U.S. currency. In fact, over the last year and a half, the U.S. dollar has gained strength.
Well, we've seen tremendous deterioration in the prior 3 years. We saw the dollar drop by about a third.
As U.S. interest rates were coming down.
Well, or as they remained low. Sure, for the last year, the dollar has gained some ground against some of the European currencies. It's actually lost ground against a few other currencies, particularly the commodity currencies like the Canadian dollar and some other Asian currencies. Of course, the Chinese renminbi has risen this year against the dollar. But I think this has been a pause. I think the dollar is going to resume its decline next year, and I think it could decline sharply. In fact, you have former Fed Chairman Paul Volcker, who has recently commented he believed that there was a 75% chance that the dollar would collapse.
The timing of that, I suppose, is the key thing. Is this something that we're talking about over a 10-year horizon or less? And we're going to talk about that next, because I know we're coming into a commercial break and we're going to run out of time, but we're going to have a lot more after this. Please stay with us. What do you think of this group? I know overall you don't like U.S. markets. However, this is a group that seems to be doing extremely well in this environment. What do you think of the brokers and the financials?
Well, I'm very negative, as you can imagine, on any industry related to financial services, because financial services are only viable businesses so long as there's money to lend. And that money is coming from foreigners who, as I said, are going to stop lending. And the American borrowers, are already so loaded up with debt. And unfortunately, a lot of borrowers in the United States have adjustable rate debt. They don't have rate that's fixed for a long period of time. So as interest rates keep getting higher and higher, it's going to become more and more burdensome for Americans to carry the debt that they already have, let alone try to incur new debt. And so that's going to be very negative for financial services.
Isn't that the whole point of leverage? I mean, isn't that how businesses grow and how economies expand, is using leverage? And people will argue it's been very cheap money. And in fact, some may even say that it was a wise investment to use the cheap money while it was available. Well, it has been cheap money, but the problem is we didn't use it for investment. We used it for consumption. So there's a big difference between borrowing to build a factory and borrowing to take a vacation or to buy a television set or remodel your kitchen. When you borrow to invest in a factory, the factory produces products that can be sold, and the revenue from those products can be used to repay the debt, service the interest, retire the principal. But when you borrow money to just take a vacation or buy a television set, you've got no asset to help you repay the liability, let alone all the extra interest that you've now incurred. What about specifically a very specific group, which is the brokers? Among the better performing, these stocks have done extremely well within the financial group. What do you think of that group?
Well, I mean, they've certainly done well for their employees, for their executives. They haven't,
for the shareholders.
Well, I don't think they've paid much in the way of dividends relative to what you can get in other assets. Now, sure, stock prices have gone up, but that's not going to do any good if you don't sell. Stock prices can be up today. They can be a lot lower in several years. And meanwhile, if the stocks aren't paying good dividends, nobody's really making any money from the company other than the employees.
Goldman Sachs, for one, hitting actually a 52-week high as we speak today. The stock is up about 18% just in that time period.
If you sell. Unfortunately, a lot of people won't sell, and these are just paper profits. The only thing that's really real are the dividends that they pay, and unfortunately, most of these companies don't really have any earnings available for dividends. I mean, what's the dividend on the stock?
Goldman Sachs is paying just about 2%. Morgan Stanley, I believe, is paying about 3%.
Yeah, what's so exciting about that?
You've got, I know, stocks that are yielding much, much more than that.
Of course,
we're going to talk about them, and we'll name some names in terms of stocks with high yields after this. We're going to be right back after this break. This is Open Exchange. everybody. If you're just joining us, I'm Susie Assad, and this is Open Exchange here on Bloomberg TV. My featured guest today is the CEO of the broker Euro Pacific Capital, Peter Schiff. He does proprietary research on and sells non-U.S. stocks. We're going to hear a lot more from him in the next 30 minutes. Sales at GM and Ford probably declined last month as the hurricanes and the higher gas prices are crimping consumer confidence. The big three are dealing with slumping sales by cutting the number of suppliers that they use and asking for price cuts from those suppliers. One company that's earning hundreds of millions of dollars at a time when some of its rivals are losing billions is the Washington, D.C.-based Harman International, a company that makes sound and information systems for luxury cars. Its chairman is Sidney Harman, joining us this morning from our studio in D.C. Mr. Harman, thank you very much for being with us today.
Not at all.
Sir, how do you how would you characterize the current environment that you're in right now?
It's, as we all recognize, a generally difficult environment. Our position in that otherwise difficult environment is, I think, quite special.
But I think it sounds like you have a good business. But for investors, when you say that your earnings are likely to be very cyclical and very related to the auto sales in general, I mean, if there were
I didn't understand your question.
Well, from an investor point of view, wouldn't you think that your earnings are cyclical?
Yes, I now understand the question. Of course. You sell more automobiles, the chances are increased that there'll be more of our systems incorporated in them.
Right.
You sell fewer automobiles, and that's not a very positive environment.
Yeah, and the problem
nonetheless, what you have to do, and I'm speaking about this in market terms, not in investor terms, what you've got to do is to measure the size of the marketplace, and the marketplace for our systems is enlarging.
Well, unfortunately, we've had several years, or fortunately for your business thus far, we've had record car sales in the United States for a number of years, and unfortunately, American consumers have taken on a tremendous amount of debt to buy those automobiles, and I think what we've done is we've moved forward years and years of auto sales to the last few years, and I think as the economy enters recession and interest rates rise sharply, I would expect a substantial reduction in the number of new cars that Americans buy, and therefore I would look for earnings going forward for your business to be under a lot of pressure. So from an investor point of view, I think we can wait to buy the stock.
Mr. Harman, go ahead. What are your response to that?
Yeah, you've made your point of view perfectly clear, and it's reasonable if you assume that the total size of the market is static. In this very special circumstance, it's simply not the case. The numbers of luxury cars may reduce. Not just American cars. You'll notice that most of our sales have been conducted with the major European makers. Total numbers of luxury cars may reduce. The total number of vehicles for which these systems are being applied is multiplying significantly.
What percentage of your sales would go towards export markets?
You'd have to define export markets. There almost isn't any such thing anymore. We manufacture these systems for the American automakers, for the European automakers, for the Asian automakers, and they sell those systems all over the world. In fact, they manufacture them all over the world. When we sell systems to BMW with plants in Germany and the United States, you tell me which part of that sale is export.
Well, on that note, we end our discussion here, and Mr. Harman, we thank you very much for being with us this morning.
Well, thank you very much.
Thanks to Harman International Industries Chairman Sidney Harman. Coming up next, we're going to take you to the New York Stock Exchange to find out what's moving in today's session. Also, we're going to talk about the U.S. real estate market, which certainly is bubbly, but there are lots of opportunities overseas for profit, so we'll talk about that with our featured guest next.
In addition to that, just wanted to broaden it out a little bit. I know you all have been talking a lot about U.S. versus foreign stocks, and I wanted to look at valuations in particular on this topic. If you look at U.S. stocks as measured by the S&P 500 and their forward PEs there, you've got the S&P trading at 15.9 times forward earnings. The other indices and countries you see listed there have all hit records in recent weeks, the benchmarks in these countries. And you can see as a result, Brazil's still only trading at 8.1 times forward earnings, but you can see Argentina and India that we've seen the PEs creep up a little bit there and the valuations creep up a little bit there. So I wanted to talk to our guest about the valuation issue. I know you've talked a lot about reasons why you're staying away from U.S. stocks, but here if you look at this measure, valuations of some of these other countries are coming up pretty significantly. Does that mean that U.S. stocks are relatively inexpensive, or do you think still that we're seeing good values overseas?
No, I think U.S. stocks are very expensive as measured against stocks in other countries. Also, I think our earnings estimates are likely to prove much too optimistic relative to some of the earnings assumptions that you find abroad. But we find much better dividend yields, much lower PEs in other countries. And of course, the main reason that I have been recommending that investors have such a heavy weighting abroad is because of my belief that the U.S. dollar will see a substantial decline in its value. So rather than owning assets that have their incomes denominated in America and pay dividends in dollars, we want to invest abroad so that we can have income streams coming to us paid in currencies of appreciating value.
Peter, before we start talking about stocks that you recommend, what are the risks associated with some of these recommendations? Are these companies, for example, who tend to be a little more illiquid than what we're used to in the U.S. markets?
Well, not really. The stocks that I've been recommending for my clients at Europe Pacific Capital tend to be relatively liquid for individuals. I mean, certainly for funds, for mutual funds, markets in many of the countries that we're involved in are quite small. So for people who are trying to invest billions of dollars at a time, they might find problems. But for a typical individual investor investing a few thousand or a few hundred thousand, these markets are very, very liquid.
Are you looking mostly, do you start off looking regionally and then you work your way into specific sectors and specific companies, or is it the other way around?
Yeah, we're looking more at the big picture. I'm trying to invest in those countries and those economies where I think their currencies are more likely not to diminish in value. You're looking for countries where individuals have high rates of savings, where central banks are more likely to respect the interest of savers rather than the interest of debtors, as you would in the United States. And of course, my clients have financial assets, so they're savers. They're in the minority in America, and that's a very dangerous position to be in. But we're looking around the world. We have a pretty good weighting in the natural resource type economies like New Zealand, Australia, Canada, a lot in Asia.
What are some of the stocks that you have there?
Well, we've mainly been investing in the resources sector, in oil and gas, also quite a bit in commercial property. We've been investing in commercial property pretty much around the world, in Europe, in Asia, because I still think there's value there. I think there's good dividend yields, and I think it's a very conservative way for Americans to get money out of the dollar and to get, in many cases, tax-favored dividends, because these foreign investments still qualify, in most cases, for the lower dividend tax.
Any specific stocks or specific names you want to leave us with?
I mean, I can mention stocks. I mean, no one in the United States is likely to know what they are. Well,
they could look them up, I'm sure, if they're interested enough.
Sure. Just don't buy them through your typical broker, because a lot of these foreign stocks trade here on the pink sheets. And what happens is you take a very liquid stock that might be liquid in Australia or New Zealand, and you trade it on the pink sheets, and all of a sudden it becomes very illiquid, and there's a very wide spread. But we're buying property stocks down there. Our biggest holding in New Zealand is Kiwi Income Property. In the Netherlands, we've been buying Verdelhav, Ascendis in Singapore. Thank you.
And a quick break. Peter Schiff has, of course, been our guest for the hour. We've got a few final moments with him. And Peter, we talked earlier on in the show about those high dividend yielding stocks that you have promised. So we want to find out some names of some of the companies that you're buying, that you're investing in, that do deliver these high dividends.
Well, some of the best dividends that we've been receiving are in the Canadian oil and gas trusts that we've been buying over the years. Stocks like Shining Bank, like Viking Energy, like Baytex. We've been buying them for clients for 5 or 6 years. Many of these prices have doubled or tripled over that period of time, but they're not expensive relative to the values of their oil and gas reserves, and they have dividends of 12, 14% annually. They usually pay on a monthly basis. Now, some of that is return of principal, but I've found that most of these stocks have increased their reserves as fast as they've been depleting them. So our principals have actually been rising, even though we've been getting tax-favored dividends. Again, the real estate trusts around the world are some of my favorite ways to invest, and these are just commercial REITs. In most of the markets that we're investing in, residential real estate is expensive. I don't think it's a bubble like it is in the United States. And, unlike Alan Greenspan, I don't need a bubble to burst before I can recognize one. This isn't a bubble-esque or frothy. We have a real, full-fledged, massive real estate bubble in the United States in residential property. But I wouldn't invest in commercial property here either, because I do think rising interest rates and recession are going to depress the value of commercial property. But residential property in America is much worse.
You're also holding on to some companies that invest in the Canadian oil sands and in energy out of Canada. Who do you like there?
Yeah, well, we have positions in companies that are going to benefit from Canadian oil sands, like Canadian Oil Sands Trust or Suncor. These are businesses that are going to get more and more profitable as the cost of energy rises. But these are far more speculative vehicles. They don't have the dividend yields. See, my main philosophy right now, what I'm trying to accomplish with my clients, is to avoid risk. And the risk right now is in the U.S. market, it's in the U.S. dollar, it's in U.S. financial assets. And to avoid those risks, we're trying to get our money out of harm's way, out of the dollar, but also provide real meaningful dividend distributions to my clients, particularly dividends that are in foreign currencies, so that they can weather this economic storm that's coming, so they can afford the increasing cost of living.
Bearish on U.S. equities?
For a while. I mean, I've been bearish since the late 1990s. And as I said, I recognize the U.S. stock market bubble as a bubble while it was still inflating. And I don't think we've seen the lows of the U.S. stock market. I think the lows that we had a couple of years ago are not the bear market lows. I think we're still in a major cyclical bear market that's going to continue. Our clients started to do very well, starting in 2000. So our bull markets abroad really began when the U.S. bull market ended. And I expect that to continue for some time as well.
Well, Peter, we thank you very much for your views and for coming on with us today.
Thanks for having me.
Our thanks to Peter Schiff, the CEO of the brokerage firm Euro Pacific Capital.